First, Ben Bernanke, our central bank governor, has cut our lending rate from 5.25% in September of last year to now 1.5%. Up until 2 weeks ago, he'd only gone to 2%, but last week we had a coordinated global interest rate cut with Britain, Europe, Switzerland, and Sweden, an unprecedented global interest rate cut, I should add, that has now brought our core lending rate down to 1.5%. Ben Bernanke is also now on the verge of injecting $900 billion of new liquidity into the U.S. financial system, as well as engaging in lots of currency swaps with foreign central banks to also provide them with dollar liquidity. The balance sheet of the Federal Reserve Board will have doubled in the next 2 weeks, and by the end of the year, it might have tripled. It increased by 50% in the last 3 weeks, and prior to this increase, the last 50% increase in the Federal Reserve balance sheet took 14 years to achieve. Ben Bernanke has pursued these aggressive policies because of his intimate knowledge of the economic history of the 1930s. 6 years ago, the University of Chicago hosted a great 90th birthday party for Milton Friedman. 300 people came. Ben Bernanke was the luncheon speaker. He devoted the entire speech to reviewing the things that Milton Friedman had written about the Great Depression of the 1930s and all the policy errors of the Federal Reserve Board in that period. And he finished up the speech by turning to Milton Friedman and saying, "We will never again make those mistakes." And the history of the last 9 months of U.S. monetary policy is Ben Bernanke carrying out his birthday promise to Milton Friedman in November of 2002. He has been working effortlessly to try and prevent this financial crisis from turning into a new Great Depression, because he understands the linkages between the financial markets and the banking system, the financial linkages between the banking system and the real economy. So we're very lucky to have had, as our central bank governor here in the last year, somebody with such an intimate knowledge of the 1930s, somebody who has an understanding of how these events did give us the tragic outcome of 70 and 80 years ago, and is now working so hard to prevent it from happening again. Secondly, the President and the Congress agreed last February to give the American people this spring a $110 billion tax cut to try and stimulate consumer spending. They also offered the business sector $50 billion of accelerated depreciation allowances to encourage more capital spending here in the year 2008. Thirdly, Barney Frank, the head of the House Financial Services Committee, persuaded the Congress in June to enact a big mortgage insurance program to try and help relieve troubled borrowers from their high mortgage rates and from the risk of default. Under this plan, the FHA, the Federal Housing Administration, will offer to the private banks $300 billion of mortgage insurance if they will write down the value of their loans to the new nominal value and then offer the reduction in the nominal value to the home borrowers.